Hello and welcome to this FNB webinar. My name's Hayley Lorimer and I'm a staff member at the FNB, and thank you very much for joining us this afternoon. We're here to talk about pensions, which is one of those subjects that, funnily enough, the older you get, the more interesting and important that topic seems to become. But particularly if you're an employer joining us today, I think our speakers are going to be sharing some information with you that you're going to find useful to have, and an opportunity to ask them questions at the end as well. We've got two speakers with us today. We've got Steve Coates, who's an independent financial advisor from Star Financial Solutions down in Kent, who's going to set the background and give us all the context around employers and pension schemes. And then we've got Rachael Barber from the People's Pension, who are a long-standing partner and supporter of the FNB, who's going to talk about what they do at the People's Pension. The webinar will take about 45 minutes or so to get through, depending how many questions we get. And on the subject of questions, if you do have a question for either of our speakers, if you just hover your mouse down at the bottom of the screen there, you'll see the Q&A box. So just type your question in there, and then the speakers will deal with those at the end of their presentations. We will send out a follow-up email as well, so that will have copies of slides and a link to the recording. And the other thing that will be in there is a little survey, a link to a survey, really short survey, a couple of questions. Please take a couple of minutes just to fill that in for us, because it's useful feedback for us to know if we're hitting the spot in terms of the kind of information that you need from us. And please give us any suggestions on other topics that you'd like us to cover as well. So that's the end of the housekeeping part of things. So without further ado, I am going to hand over now to Steve, who is our first speaker this afternoon. Thank you, Steve.
Okay, thank you very much. Good afternoon, everybody. I'm just going to share my screen. Done that correctly? Don't think I have. Hold on a second. Okay. There we go. Okay, so today we're going to have a little bit of a whiz through auto-enrolment and have a look at a few aspects of it. Some of you may or may not be aware of auto-enrolment. It's been around a while now, and going to look at how it affects you as employers. So we're going to be covering off some food for thought at the beginning as to perhaps why auto-enrolment was introduced in the first place. Look at the key aspects of auto-enrolment, the costs, how it affects you, and then talk about what the retirement options are when you get to the other side. And as Hayley said, the closer you get to the end, the more important this becomes. Going to look at some of the HMRC allowances, which have recently changed as well. And then a few what ifs at the end. Food for thought. This is a quote from the former pensions minister, Steve Webb, that many millions of us will be spending around a third of our lives or more in retirement in the future. Now that's based on the fact that at age 65, the average life expectancy is around about 22 years. So most people will be living on average 22 years in retirement. Now, as a nation, we are appallingly bad, or were appallingly bad at saving for our retirement. So the government was faced with some choices that it had to make, primarily because there's a pensions gap. The baby boomer generation, of which I am one, are to blame for all of this, and they get the blame for everything. But in 2019, there were 12.4 million people aged 65 and over, which was 18.5% of the population. The number of people aged 65 and over increased by nearly 20% between 2011 and 2021, and is projected to increase to 16.9 million by 2035. On top of that, we're actually living longer, and the number of people over 85 will double over the next 25 years to 3.1 million people. Now, obviously, all of those people are going to be claiming state pensions. They'll be taking resources from the NHS, etc., because the NHS is very good at keeping us all alive for a longer period of time. So it presents a problem to the government, and you have more people taking out and less people paying in. And added to that is we are an aging population, but we have a falling birth rate. So we're not replacing the people who get to retirement. So the government has some choices to make, and this isn't political, it's any government that comes to power. And in fact, it's probably any Western country government has the same problems to look at. So they could have made pensions compulsory. Compulsory superannuation is, or pensions has been brought in some countries, but the government didn't go to compulsory pensions. Auto-enrolment is not compulsory. The employee has the option to opt out if they don't want to be in the pension. They can increase the retirement age, which they have actually done. State retirement age is being aligned at age 67. So potentially state retirement age could increase again. Auto-enrolment was the government's alternative, and all of it is to promote a savings culture. As I said, we are appallingly bad at saving for our retirement. Or was. And since 2012, the plus point of auto-enrolment is increased pension savings massively, particularly in the younger generation. So how does this affect you as employers? Well, since 2012, employers have been required to set up a qualifying workplace pension scheme. If they employ at least one person, if that person is aged between 22 and state pension age and earns over £10,000 a year, work or usually works in the UK, now these employees would be called eligible job holders, and they must be auto-enrolled into a qualifying workplace pension scheme. They must be auto-enrolled into a workplace scheme, even if they don't want to be involved in the scheme, or they tell you that they're going to be opting out. You still have to set up a scheme and auto-enroll them. If you have employees who are aged between 16 and 74 and have income in excess of £6,240 per annum, then they can ask to be auto-enrolled into a scheme. So if you have an 18-year-old who earns £10,000 a year, then they could ask to be auto-enrolled into your scheme, and you would have to pay a pension contribution for them. These people are called non-eligible job holders, and if they opt in, then you're required to pay a contribution for them. The last category is employees who are aged between 16 and 74 and have income below £6,240. Might be part-time people, for instance. These are called entitled workers, and they can join the scheme, but you don't have to pay a contribution for them unless you want to. Now, all of these categories are on the TPR website, the pension regulator website, and you can get that printout from them, which will run you through what they are. All of these categories should be assessed through your payroll provider, and certain payroll softwares, particularly like Sage, is what I'm familiar with, will assess each one of these people in terms of their category. So what happens if the only person your company employs is you as a director of that company? Well, directors of limited companies or officers of limited companies, such as directors, without a contract of employment, which is generally the case, are not classified as workers for the purpose of auto-enrolment and do not have to be auto-enrolled. So if you are the only employee of your company and you are a director, then you do not have to set up an auto-enrolment, and you can claim an exemption from the pensions regulator in that circumstance. This also includes company secretaries as well. So we have a look what the costs are for employers in terms of auto-enrolment. The minimum contribution is actually worded as 8% of banded earnings, of which at least 3% must be paid by the employer. Pension contributions will be taken from the employee's pay at every payroll run and will be transported to their pension pot. Employers pay a percentage of the employee's salary in addition to their pot. Into their pot. These are the minimum levels for an employer, and you can choose to pay more than the 3%, but never less. So you could, as an employer, choose to pay 8% if you wanted to, and your employee wouldn't have to pay anything, or whatever combination that you want to do. These amounts were effective from the 5th of April 2019. They were lower for a period of time from 2012 to 2019, but they remained the same since 2019. So what are the benefits for employers in terms of auto-enrolment? Well, compliance with the law and the pension regulator requirements, first and foremost, there are significant fines if you do not comply with the regulations laid down by the pensions regulator. So obviously compliance with the law to make sure your company is compliant. Every employer in the country now, if they employ at least one person, will have to offer an auto-enrolment pension scheme. So it ensures you maintain a competitive position in attracting new staff and with your competing companies that are close to you. If you choose to pay more than the minimum, then this can make your company seem more attractive than a competitor and will aid staff acquisition and retention in those circumstances. So one of the big questions I get asked is, oh, this is just a way for the government to opt out of not paying state pension. Well, the good news is that auto-enrolment does not affect your state pension entitlement at all. The new full state pension for an individual is now £203.85 a week from April 2023. Recently increased by 10.1% due to the triple lock. It's payable from state pension age, which will be gradually increasing to age 67 for women. Minimum 10 years NI contributions required, 35 years NI contributions required to get the maximum contribution. I would urge everybody who is maybe a little bit unsure, you can go onto the pensions, the state pension forecast website, and you can get a pension forecast for yourself, and it will tell you exactly how many years national insurance contributions you've made and what your forecast is, and you can make up the shortfall if you want to. Employees will be automatically enrolled into a workplace pension scheme to make saving easier and efficient. So the government is effectively enrolling them, and they will physically have to do something to opt out of the pension. The government aims to encourage more people to have state pension and additional income for when they retire. As I said before, we've been appallingly bad at saving for our pension, and a number of people who have state pension and a tiny little pension fund is quite common to see. And I think if we're looking forward, that what the government want to avoid in 20, 30 years' time, that's not the case. So the government will also give you some assistance towards your savings, and they do this via tax relief. So employees' pension contribution will be taken net of basic rate tax relief. A tax rate of 20% for every £10 of your employee's pension will only cost them £8 in their actual in what they've taken. So they get £8 taken, they get £10 put into their pension. The extra £2 will be paid by the government as tax relief, and employer contributions will be paid on top of this. However, if you have an employee who is a higher rate taxpayer, they can also claim the additional 20% back and get 40% tax relief on their pension contribution. So worst case scenario, they're going to get 20% growth on their money on day one, and they could get 40% growth on their money on day one. And lastly, employers will receive corporation tax relief on their contributions. So your contributions that you pay from your company will receive corporation tax relief as well. So use a little bit of a sweetener for yourselves as well. So if we have a look at what the options are at retirement. So primarily there are perhaps 4 options that we can look at. One is what most people do is they take 25% of their fund as tax-free cash. Everybody can do that. So you can take 25% of whatever you saved, up to 1,067,000, you can take as tax-free cash. 25% of 1,067,000. The remaining pot you can access at marginal rate tax. So if you're a non-taxpayer, you could take it as up to 12,570 as tax-free. Anything above that, you would be taxed on it as normal income. You can take that until the pot runs out. So you could take as much as you want to until the pot runs out, and you access this through what's called Flexi Access Drawdown. The other option, which is less risky and is perhaps going to become a little bit more popular now due to rising interest rates, is that you can buy an annuity. An annuity is guaranteed income for life from an insurance company. You go to an insurance company, they will give you an income for the rest of your life. And annuity rates have improved significantly in the last 6 months. The good news is you don't have to make these decisions until the day that you actually come to retire. So as I mentioned before, HMRC has a couple of allowances. The first one is the annual allowance. This is the amount that you can contribute to a pension per tax year. This is currently at £60,000 for the 2023-24 tax year. There are some caveats and conditions around that, but in simple terms, it's £60,000. In addition, there is a lifetime allowance, or there was a lifetime allowance. This has recently been abolished, but could be reinstated in the future, for instance, if there was a change of government next year, as the Labour Party have already said that they will reinstate it. So lastly, let's have a look at some what ifs. What if you don't make it to retirement? What happens to your money? Who gets your money in the event of you dying? Well, the good news, in the event of your death before age 75, you can nominate anybody to receive that money, and they will receive that money before the age of 75, tax-free. No tax at all. Go straight to your nominated beneficiary. If you die after the age of 75, your nominee still receive that money, but if they draw it down and to take it out of the pension fund, then they will be taxed on it at their marginal rate. And the other good news is that there is no inheritance tax payable on this money. So the tax benefits around death are very good on pensions. And what it does mean is no faceless insurance company or pension provider will keep your money. It will go to anybody or to the person that you nominate. So who can you nominate? Well, you can actually nominate anybody. Anybody can receive it. It doesn't have to be a blood relative. Generally speaking, it would be mother, father, spouse, etc. But it can be anybody. You can change it at any time. It's not like it's a simple form that you can usually complete online, or you can get from the pension provider. Send that off, and that's job done. And the good news is after your death, the money goes to your nominated person. If they then die, they can nominate someone else to receive that money. So your money will pass down your family line, and someone will receive that money. Nobody's going to keep your money, which is obviously good news and is a comfort to a lot of people. So that's sort of a bit of a whistle-stop tour, and obviously I'm conscious we've gone through that quite quickly. And if you have any questions, then please do ask.
That's great. Thank you, Steve. So yeah, as Steve just said, any questions about any of that, please just pop them in the Q&A box. But that was packed with useful information, I'm sure. Thanks, Steve. I'm going to pass over to Rachel now, who's going to share her screen, I think, and
that's the plan anyway. Let's see if I
we'll deal with the questions at the end, Rachel.
That's fine. Let's have a little look. Oh, 1 second, sorry, my little bar's in the way. Here we go. Oh, no, I've gone too far. Perfect. Can everyone see that okay?
Yep.
Yep.
Fantastic. So yes, thank you. My name is Rachael Barber, and I'm one of the relationship managers here at the People's Pension. And today I wanted to cover off consolidation. So Steve has set the scene really for your obligations as an employer when you're setting up a scheme, but I really want to talk about consolidation and what that looks like if you've been with the provider, and for one reason or another you're now looking at switching. Before I do that, though, I'm conscious for some of you, it could be a case that you're familiar with who we are at the People's Pension. You perhaps have a workplace pension with us. For others, you might be sitting there thinking, I have no idea who they are. So essentially, a little bit of scene setting in the first instance to give you an insight as to the who, the what, and the why, really, of all things People's Partnership. So we started out life as B&CE. And we've recently changed our name to People's Partnership because we wanted a name that really aligned with our purpose as an organisation. We really want to partner with people in order to help them build better financial foundations for life. Now, we're a profit for people organisation, and that's our way of saying not for profit. So unlike some of our other competitors out there, we aren't responsible for paying shareholders. Instead, we use all our profit to put back into our members to help support in generating better outcomes for all of our customers. And the People's Pension is a product that sits under People's Partnership. And we launched back in 2012, as Steve said, when auto-enrolment was introduced. It posed a huge challenge for lots of employers, and the People's Pension was designed to help make that as pain-free as possible. So fast forward then to current day, what does that actually look like in numbers? And there's some big numbers on the screen for you. So we look after over 100,000 employers. So over 100,000 employers have chosen us as their home for their workplace pension provider, making us one of the largest master trust workplace pensions within the UK market. Those 100,000 employers then send us over £300 million worth of new contributions every single month, helping our members and your employees, if you're with us, save their way to a better retirement. We also look after over 6 million members, and that number continues to grow. 1 in 5 of the UK working population currently have a pension pot with us, which is staggering. Interestingly, well, I think it's interesting, on average, during your working life, you have approximately 6 jobs. So that, compounded with the fact that 1 in 5 of the UK working population has a pot with us, there is a significant chance, if you haven't had any interaction with us, you probably will throughout your career. And the last number that I wanted to cover off was that £20 billion of funds under management. We've actually gone through the £21 billion fund under management mark now. And this is the money that our members trust us not only to protect, but help grow for their retirement. So from inception, where we've gone from a standing start to absolutely no members and no employers, fast forward 11 years, we've grown massively and we continue to build on that success. So hopefully painting the picture that we know what we're doing and we're a safe pair of hands. So I mentioned the 100,000 employers. It's important to say that not every single one of those 100,000 employers were with us from the day in which they started to have a workplace pension in place. And this is where consolidation really comes into its own. What we've seen is back in 2012, and Steve touched on this earlier, the perception was for lots of employers, they had to have a workplace pension. There was no choice. It was a bit of a necessary evil, something that they had to do in order to be compliant and not be told off by the pensions regulator for being naughty and not doing what they should. Over the years, what we've noticed is actually employers are starting to really understand and recognise the importance and value that having a comprehensive workplace pension has in place, not only for their staff, but also for them as an organisation, a really useful tool to retain and attract new talent within the business. As I mentioned, consolidation is something that we want to talk about today, and there's a whole myriad of reasons as to why employers perhaps want to explore switching from one provider to another. It could be that they set up a scheme when they first stage because they wanted to tick a box, their business has grown, they now want to add something that's slightly more bespoke, a couple more bells and whistles for their employees to really help drive and use that as a retention tool for staff. It could be that they're running multiple pension schemes. They've got one over here and one over there, and it's costing a lot of time and money to deal with both. And they want to find a safe home to put everything into to reduce the costs and time that it's taken out of their day to run those schemes. More often than not, though, consolidation is often prompted by areas of dissatisfaction or issues when administrating the scheme. It could be that your payroll software is not compatible with your current provider. It could be that you've had ongoing administration issues, their systems are clunky. It could be that you try and call them and no one's there at the end of the phone. Whatever the reason for having this conversation or exploring it as an option, we are here to help. We have a tried and tested process in place to make this as pain-free as possible for you. We're really aware that when it comes to switching from one provider to another, there can often be a sense of nervousness, especially where there has been areas of dissatisfaction. And we certainly don't want you to feel like you're jumping from the frying pan straight into the fire. So that's why we've developed this essentially handheld process to make the transition from one provider over to ourselves as seamless as possible. So what does it look like in a nutshell then? So we split it into 2 main parts. First, from the employer's perspective, looking at the scheme and getting that moved over from provider A over to ourselves. The second part then is supporting the members or your employees at consolidating any previous arrangements that they might have. And that's not just exclusively the pot they have with your previous pension provider. It could also be the pots that they have elsewhere from previous employers, etc. So what does that look like then? In practice, what does it look like? So we have a team of implementation managers whose sole responsibility is to support employers moving from pension provider to ourselves. They come with a wealth of experience. So it doesn't matter whether or not you've got 2 members or 2 employees or you have 150. They are there to handhold and support from start to finish. We understand that actually when a scheme is implemented correctly from day one, it tends to continue to run smoothly throughout its duration. So they provide support with things such as setting a timeline of events, so everyone is singing from the same hymn sheet. They will also help support in the initial sign up, taking into consideration the different levels of contributions that you'd like to pay or the different basis in which you'd like to deduct those contributions. They'll also provide support surrounding our systems as well. We appreciate that systems can look and feel different from one provider to another. And what we don't want you to do is feel left high and dry. You've made the decision to come over to us and we've gone, thank you very much, see you later, good luck. It is a case that they would sit down with you and provide adequate training and demonstrations so you know how to do, for example, the data processing and submission of that data on our system. And they'll ensure that your members have been enrolled and joiner pack information sent out. One thing that's really important is communicating things to your staff. As I've said, we've seen a huge shift in employers' mentality and perceptions of workplace pensions. And as such, you want to sing and dance about all the great stuff, all the added value and benefits that pensions are providing. So communications are key in delivering those types of messages. And it's something that we do particularly well. We understand the importance of clear, effective communications. Talking pensions with your people is really, really important. It's not a sort of one and done exercise. And there's lots of things throughout the auto-enrolment journey that you have to communicate. For example, re-enrollment, when you're doing your warm-up communication to say, look, you're going to join a pension scheme. But it's more than that. It's more than that. And in order to help you promote the benefit of your workplace pension scheme, we have a whole resource of handy collateral that you can use in order to deliver those messages to your people. And the way we do it is in the form of our communications toolkit. So this essentially is a house where we keep all of our comms that are available for you. And it's not just template letters and payslip wordings, but it's flyers, it's posters, it's leaflets. Everything is contained in one place. It's all downloadable, it's all editable, so you can pick and choose what you want to talk about and how you want to talk about it to your people. We understand that, generally speaking, our members understand the importance of saving for retirement, but there is a sense of nervousness surrounding making decisions for themselves. Perhaps it's due to not having enough knowledge, or with all the scandals of the past, not trusting financial institutions. We believe by using clear and simple language when explaining sometimes quite complex topics, it really helps resonate with your employees. As a member then of the People's Pension, what does that mean for your employees? So they will have access to an online account. And this ties in really nicely with some of the stuff that Steve was talking about. So on the online account, they can update personal details, they can obtain valuations as to where they are in terms of their pension saving. But there's a couple of things that we always encourage people to do, practical tips to take away and action. If they don't do anything, do these couple of things. One of those is nominating their beneficiary. Out of the 6 million members that we have, 5%, only 5% have gone online and nominated their beneficiary come their death. And it is so important to do it. We want to know, when you've passed away, who is it you would like your money to go to? And it's a simple case of activating your online account, logging in and putting someone's name in there. And it could be the difference from when you've passed away, us paying out your money to the right person within a couple of weeks, to having to go through this whole rigmarole of finding out who it should be and understanding the situation, and not paying out monies at a time when your loved ones probably need it the most. So I encourage anybody, if you are a member of the People's Pension, if you haven't nominated your beneficiary, please do that. Another thing that they can do as well is the transferring of existing pension pots. So this ties in really nicely with talking about consolidation at scheme level. So we've moved over your scheme, your employees have been enrolled, they've got a brand new People's Pension pot, but what are they going to do with the existing arrangement that sits over here? By logging online, they can simply complete our transferring in form, and that will get the ball rolling for us to contact your previous pension provider and say, please, can we have Joe Bloggs's pension pot from you moved over? And that's it. We don't believe in overcomplicating things. We want to keep things as simple as possible and not put any additional obstacles in people's way to keep everything in one place. We did some research, and 1 in 5 people currently have a lost pension pot. That's incredible. And you think about how transient we all are in terms of employment these days. And, you know, gone are the times where you're sort of lifer. You start work at 16 and you work for the same company until you retire. That just isn't the way in which we will work and operate anymore. So it's really important to keep tabs on your pensions and at least know where they are. Appreciate consolidating is not necessarily for everyone. And what we do, as well as provide effective communications, we also have dedicated teams readily available to support employers and our members when having these types of conversations. So we have a guidance team that sits within our UK-based award-winning call centre down in West Sussex, in sunny Crawley today, and they're there to provide guidance. And we aren't authorised to give advice, but what we want to do is help people in signposting them to things that they ought to be considering when making these decisions, so they have the empowerment, the right information to make the decision that best suits them. So if you have a question about, oh, I've got a pension pot over here, what do you think I should do? We can't tell them what they should do, but what we can say are, these are the list of things that you should be looking at. You should be looking at costs and charges. We don't want anyone to be financially disadvantaged by consolidating into the People's Pension, but we do want to provide them all the relevant information in order to make informed decisions. Appreciate I've given you a bit of a whistle-stop tour there of all things consolidation as well. But if you do have any questions or like to pick this up separately and discuss it or sort of specifically on a case-by-case basis, we do have a dedicated team of relationship managers readily available to discuss this with you. Their contact information is on the screen for you now, so take a note of it. But yes, if there are any questions, I would welcome them and be happy to answer any that we've had in.
Okay, thank you, Rachel. So we will of course put those details in the follow-up email, and Steve's details as well, and also the links to the pensions regulator website and the state pension forecasting website that Steve mentioned. We'll put those links in the email to make it nice and easy for people to go and visit those sites. So we have got a couple of questions. First of all, with regards to all of those people who haven't filled in their nomination forms, which I agree with you, but you know, both of you would say this is really important for people to do that, to go in and nominate who they want their money to go to, because none of us know what the future holds, do we? So it's well worth doing that. What happens to all, there must be some money that never goes to beneficiaries because people haven't done that. So where does that just get ploughed back into the general pension pot, or what happens to it?
Well, most pensions are set up under a trust arrangement, so the pension company would be a trustee, so they would be duty bound to pay that money to somebody. So if somebody hadn't filled a nomination form in, then generally they would try and find out who is the person that money should be paid to.
Right.
So there's not a situation where there's an orphan fund where the money just gets ploughed back into the pension fund. As far as I'm aware, certainly not. I would think with people like the People's Pension is a master trust, that's just not going to happen.
Yeah. Oh, well, I'm just thinking of a personal situation of mine where I don't think that is going to happen. But anyway, that's a different scheme entirely, the People's Pension. So yeah, interesting. A question for you, Rachel. Is the People's Pension, is the portal that people use and all of the software, is it compatible with Sage and other accounting packages?
Yeah, absolutely. So we work really closely with third parties, such as our payroll providers. And in some instances, as with Sage, as with Xero, there is an automated integration. So what that means is instead of having to do this sort of download and upload of files with the data surrounding employees and their levels of contributions, your payroll professional, your accountant, sits within their payroll software, clicks a button and automatically sends that data and that information over to us. It's really fantastic because it reduces human error, reduces time, costs. So yes, we are. But if we don't have that automated integration, we've got multiple ways in which you can submit that data through the file upload process. Alternatively, we can also facilitate manual keying. So if you've only got 2 people and you want to input their data, that's something that we can help and support you with as well.
Okay. All right. Thank you. And with regards to that switching process, are there fees involved in doing that, and how long does it take? Is it relatively straightforward or not?
Great question. Yes is the answer. It is relatively straightforward. Obviously, there will be some nuances depending on the complexity of the scheme. The larger the scheme, generally speaking, the longer it takes because there's certain things that we want to take into consideration. But from our point of view, it's very much led by the employer. So they will come to us and say, well, I want to move my scheme with effect from next month. And we will sort of work backwards to help facilitate that. So we really do lead based on what the client wants or the employer wants. Effectively, the sign up takes about 20 minutes to complete. So it can be done in a really quick amount of time. We don't need a long time to sort of set it up and what have you. In terms of fee, that's a really interesting point. So if you're a brand new employer coming to us, there isn't usually an initial sign-up fee. However, because you're switching from one provider to another and it's a continuation of your obligations, the initial sign-up fee is something that we review. And in many instances, we can waive that initial charge for the employer. So it's always worthwhile if you're sitting there thinking, okay, maybe it's something I'd like to explore or at least have a conversation about, please reach out because it is something that we can review. And like I said, in many cases, we can actually waive that fee for you.
Okay. All right. Thank you, Rachel. I think just a reflection on listening to everything that Steve said and your information as well, Rachel, that the introduction of the auto-enrolment scheme over the past 10 years or so seems to have been a real positive, really, in terms of workers when they do reach retirement age, actually having a pension pot rather than just relying on that state pension, because we all know that that's not going to stretch very far, is it?
No, I think the government's aim was to take the decision out of people's hands to a certain extent. And so you had to physically opt out. So a lot of people, when they originally introduced auto-enrolment, it was at 1%. So it was a tiny amount that was paid in. And then they've gradually increased it. So I think there are a lot of people in their 20s now who have pension schemes because they were auto-enrolled. Yeah. And I see that in lots and lots of companies. There's lots of people who have got pension schemes now and will have a pension fund in retirement. And one of the things with pensions is the longer you wait, the more you have to put in. And in simple terms, every 10 years, you would more or less have to double what you were going to pay to get the same amount. So it really is, the earlier you start, the better it is. And it's if you start in your 20s or even late teens, then your pathway is a lot better than if you start in your 40s.
Yeah, even though it's probably the last thing on your mind when
we've all been there, haven't we? We know.
Yeah.
But yeah, it's definitely worthwhile. And I think that is the one big plus point from auto-enrolment. It's massively increased the amount of money that people save into pensions. And if you look at Rachel's presentation, there's 6 million members, 21 billion pounds under management. It's huge amounts of money.
Yeah, definitely. Well, we don't seem to have any more questions coming in, but this is your last chance. If you've got a burning question that you want to put in there, type it in the box quickly before we go. But otherwise, as I said, we will send out follow-up email with all the information and the various links, etc. And do fill out the survey as well, please, because that's useful feedback for us, and ideas for future webinar topics as well. But otherwise, it just remains for me to say thank you very much to Rachel from the People's Pension, and also thank you to you, Steve, as well.
You're welcome.
Star Financial Solutions, isn't it? I keep wanting to say
easy for you to say, Hayley.
but not, apparently not. And thank you as well to all of the members for attending. And yeah, we'll see you next time. Thank you, everybody.
Thank you. Take care.
Bye-bye.
Bye-bye.
Bye.